Good evening. Just doing a really quick audio and visual check. So if you can see and hear me correctly, I'd love to hear from you over on the right-hand side of your screen. There is a chat bar. Just let me know that, yes, it's all okay. There should be a very happy lady on the screen, and I have been speaking for about 20 seconds. So I'll be getting started in a couple of minutes, just trying to round everyone up after 8. Won't be a few moments. Thank you. Okay, let's jump right in. My name's Jacob Field from Ripehouse. Thank you so much for attending and coming along and taking the time out on a Wednesday night. Lots of you have already said yes, you can hear and see correctly. Hi to Tom and David Jaro, excuse my pronunciation, Jenny, David, Bilmau, San, Nina, Lisa, David again, Tom, Peter. Look, thank you for saying yes, you can hear. There's a few more coming through now. If you are having issues with the resolution or the audio or pixelation, etc., this evening, you can click on the YouTube link that I've just shared there in the chat bar, and that can take you through to a YouTube channel directly and view within YouTube. You won't be able to chat over on that channel. Yeah. If you've got any other, you might be able to also try without going over to YouTube and maintaining the chat, just refreshing your browser, turning off any YouTube or other videos that might be accumulating your bandwidth or sucking it up, and focusing on the content that way. I'll jump right in. We've got lots of people who have arrived. I haven't hosted a webcast for about 4 weeks. Generally, every couple of weeks, we do talk about what we're seeing in the industry, any current research. What we are going to be discussing tonight is not necessarily my personal opinion or gut feel or whatever I'm seeing. It's based on hard, cold research and facts that we have pulled out of the Ripehouse research platform. And the webcasts are a great way of talking you through and showing you visually how it all fits together, and you can see the research and go off and make your decisions far more effectively. So let's jump right in. I'll start with a little bit about me. Okay, the content of tonight is about achieving mind-boggling capital growth. So we're operating in a climate as an investor with lots of other investors, and increasingly, you guys and investors out there are becoming a little bit more sophisticated. So I'm going to be taking you through a process tonight of how to use technology, a little bit of common sense, buyer behaviour, and what you know intimately about property to really supercharge our results. It's all about stacking things in our advantage, amplifying our research into the acquisition and the outcomes of property to achieve mind-boggling results. I'll talk through a little bit about some of the results that I've seen, even particularly I've been able to achieve, but then also I'll be breaking it down into what I'm seeing in September in our research to actually implement right today to achieve what there's no crystal balls, obviously, but what we can see as very positive outlooks for potential growth. I'll be also, as mentioned in the email, talking about areas to potentially avoid and how you can spot them and start seeing the stars disaligning or moving apart, the telltale signs that an area is starting to get overheated and to be avoided. Obviously, acquisition might be difficult or becoming a basket case and heading in the wrong direction. If you've got any questions, if it's relevant, feel free to jump in via the chat and ask me. If it's relevant, I'll stop right there and then and answer it for you. If not, I'll gather them all up. I'd love to keep it a very dynamic session and maintain a nice, strong conversation in a Q&A at the end. So it'd be really nice to hear from you and encourage communication and questions. Why don't I just, if you haven't answered already, over on the right-hand side, there is a poll. I'd love to hear where you are from. Currently, we've got 52% of you calling, listening in from New South Wales, 54%. 4% from Tassie. I'm actually from Tasmania. Ripe House is based in Hobart. Big shout out. Put your hand up and say who you are. I'd love to see other Tassie users. Put a face to the state. 19% of you from Victoria, 16% from Queensland, not many from the other states, 3% from ACT. It's a few of you there from, well, one from Newcastle, one from Singleton. A nice broad spectrum. I'm actually calling in tonight from a hotel room in Sydney. So big shout out to Tasmania and New South Wales. Nina, hello from Tassie. Okay, and I've got a couple of questions around macro, GFC, happening in Australia. What do you think about that? I can gather that up at the end, Farhad, and we can answer that there. Let's jump right in. A little bit about me. So I'm an investor first. I actually purchased my first property in the early 2000s down in Hobart, West Hobart for Nina, who might know where that is. Now currently own and have purchased property across Australia. I moved to Sydney about 7 years ago and lived here with my wife, Anna, for 5 years. And that really sort of took me out of my comfort zone, and I had to sort of understand and dissect the market up in Sydney or up here. It was very unfamiliar to me, and that was where Ripe House had its beginnings in 2011. So it initially started off as a way for me to quantify and dissect the Mount Druitt market, and then it's really morphed into tools that are aligned to help DIY property investors. So I'm a DIY property investor first. I love property. I live and breathe it. I also have a background in technology, and Ripe House is a way of helping other investors really achieve awesome results ourselves, for each other, and together. I also play basketball and try and keep fit that way, but I also have 2 young children, which really cuts into my basketball time. Let's jump right into the content. Just a little bit about what we're getting through. Super interactive session. Please feel free to ask any questions. Just a really quick question to start with. I'll ask it, and there's a little bit of a delay in it coming through, but do you currently rent? Do you have live in your own home with or without a mortgage? And are you currently looking at buying an investment property, or how many do you currently own? So how do you currently live, and are you investing actively or planning on it? I'd love to hear about and a bit of a snapshot of what you're all trying to do and how you're doing it and where you're starting from. I can share that with the audience, and we can try and get a little bit of an assessment about how you might fit into the picture. Okay, so what I'm going to show you is on the cutting edge. So I'm not going to be talking about research that we observed last financial year or gathered together and gone off and thought about a assumption and tried to test it and come back with an idea or opinion. What we're going to be talking about is actual real life data and research based on that data in plain and simple terms. So we're going to be able to action what I can show you today and go away and use it and implement it. I'll be going through real life case studies. So I'll be picking out what we are seeing in September, what emerging local government areas or suburbs are really aligning for pending and imminent and immediate growth. And I'll also then be doing the flip side, what areas we're seeing and how can you pinpoint areas to potentially avoid. So it's going to be real life, what we're actively seeing in our reports and research platform as of today. I'll also probably talk about, and it'll become evident, how critical it is to make timely decisions and position ourselves ahead of the masses. So what we're trying to do is we're trying to work out a system to give us above average returns compared to other investors. And the way that we have been able to break that code, I suppose, and position ourselves for outstanding and mind-boggling growth is by using the lower sophisticated masses. So we have to position ourselves just before imminent growth and using the the big groups of people who have just read a media article, or a big buying group, or a big buyers agency, or whatever it may be, using those guys to drive our growth and return. So the system I'm going to be talking through tonight, with application to current research, is all about incrementally building upon each layer of our research and understanding to deliver outstanding capital growth there at the end. So it starts off with increasing our catchment area. This is all about, this is on the left here, lower left, improving and accessing timely information to reliably look at the country for the absolute optimum opportunity, getting the local government area right in that area of opportunity, looking for the suburbs leading the local government area forward, primed for immediate growth, not in 6 months' time, not in a year, making sure we get the street sweet spot, absolutely optimum, pinpointing those streets that are delivering the growth for the suburb overall and driving that forward, looking at the exact properties that will be delivering that growth, how to negotiate and buy, and how that all fits together to deliver outstanding capital growth. So I'm going to be painting this picture throughout the webcast and giving practical examples all the way through, and you'll see how it forms together to amplify our results in a very common sense approach. It's really buyer behaviour that we're trying to tap into and leverage for our results. So as mentioned, jump in at any time with any questions. Tom's have a self-managed super fund apartment in Kedron, principal place of residence. Also looking, trying to find a great area around a 400k. Vince, single low income earner, supercharge their property portfolio. Dean, rent investor, 5 IPs. I own our 6th property, was our first in principal place of residence purchase in Lane Cove here in Sydney. So Dean, I was like you, I actually owned 5 other properties before our principal place of residence purchase. That was the way that I got into the game. I bought positive cash flow, did renovations on a lot of properties, whatever it took literally to get into the next deal, and started with really not much, and was able to then move into a suburb that we wanted to live in and start a family in here in Sydney. And that was almost 10 years after I started investing. So it's a great way of doing it. Bimau, living in your home with a mortgage, thinking more if bank helps. Nina in, Farhad, 5 properties, 1 commercial in self-managed super fund, 3 residential, 1 principal place of residence. We can see a really interesting and varied mix of how you guys are going about investing in property. Let's jump back in. Keep them coming through. If you haven't already answered, it's really nice to get a snapshot. Okay, so let's just think about it for a moment. If we could reliably access these types of returns and implement it when we need to, how much would this system be worth to you? How much would the ability to be able to piece together this and deliver these types of 25% as an example capital growth outcome in the first year? $5,000, $10,000 to be able to access that system without having to pay for per transaction buyer's agent costs or transactional costs, education, etc. Bring the numbers through. I'd love to hear from you and think, and more clarification potentially needed. Maybe even 50,000. So yeah, 10,000. Yep, 50,000. Peter said priceless. Well, it would be nice if we can, roll it out and recreate and rinse, repeat, I think is what it's all about. So I'm just going to pose that because I really want to try and break this down for you tonight, trying to tap into, I suppose, some of the transactions and information and research that I've seen in using Ripehouse, developing Ripehouse, but then also talking with all of you who are using Ripehouse and seeing how you're using it. So I'm sharing the love, I'm sharing the knowledge, and I will be breaking down a case study from another Ripehouse user shortly about how he has been able to achieve 25% average returns in the first year across his last 10 property purchases. So I'll be breaking this down. This is the system that we're going to be going through tonight, okay? Let me know if you've got any questions, because tonight is no BS. I want it to be all answers. I want you to be able to see the logic and the understanding. And if you can't, grab me, let's answer it. Let's move on together. because it's going to start very quickly. On the next slide, I'm going to jump right in, and we're going to be starting from a baseline together. I like to say a piece of the puzzle. You saw that overall flow to generate those outcomes. We think of each step along the way as a piece of the puzzle. They all combine together to deliver excellent outcomes, but they also each amplify the results of the other piece of the puzzle. So, you might get your suburb right, but you don't get the LGA right, or you might get a really good property purchase and acquisition and negotiation in the wrong suburb, or you might get a type of property that's not in demand by people moving into that suburb. You might not get the street right. You might buy in a dead spot that locals know to stay away from. People moving towards the area are not demanding. It might not be a cohesive growth story. It's all about getting the puzzle pieces in alignment to generate and amplify growth. Okay, let's jump right in. Puzzle piece number 1, increase your catchment area. So what I mean by that, you might be very comfortable and familiar with investing where you grow up, and you know how to understand value, you know the streets to avoid, you know the areas to seek out, you know potentially how to invest there better than anybody else. But there's not much chance that you're going to get the outcomes you're looking for in property around the corner. You have to wait for once in 15 years potentially to get the outcomes you're looking for. So what we first need to do is increase our catchment area of interest and improve our confidence to invest there. Improve our comfort level, access research to compare Queensland with Tasmania equal for equal, and to be able to acquire and quantify properties in these locations like for like. So we can access the absolute pinnacle of opportunity for our strategies at any time across the country. That's what it's all about. So to start and generate amazing upfront growth results, cash flow results, you have to increase your catchment area and your comfort level investing there. So this is what it's all in regards to tonight. It's a framework to be able to do this and to be able to put ourselves in the absolute optimum buying window in the catchment area. So to start with, we have to understand the nation. So the nation is obviously broken up into multiple suburbs, multiple states, each with their very distinct growth cycle and story and microeconomic factors that are influencing what is happening there. They're all moving in different directions at any one time. Okay, so Farhad's question before around the global financial crisis, you cannot answer that or you can answer it at a national level, but when you do get insight and understanding at a national level, it really is just an aggregate or an average of all the different states pulling in different directions. So even through the GFC and post-GFC, Western Australia might have been booming, Sydney might have been booming, while Queensland, Tasmania, Northern Territory were really in the doldrums. The nation is far too general. You can't purchase one property that will deliver the outcome of the nation. You have to buy a property in one street, in a suburb, in an LGA, in a state. So when you're looking at the country, it's all pulling in different directions. Very generally, we're seeing positive growth, acquisition signs. If you think of the property clock as 1 to 12, 12 o'clock at the market peak, 6 o'clock at the market trough, you're looking at market momentum growing into 7 and 8 o'clock. We like to say between 8 and 10 o'clock is our optimum purchasing opportunity. When you're getting too close towards 12, you're topping out. You don't have the upside left in the market. Anything between 12 o'clock, 1 o'clock through to 6 o'clock is the slowdown and recovery phase. That's when markets are trying to work out when they should start moving again. So our research has shown New South Wales has just fallen over into the slowdown phase. The word is out on that already. Tasmania, Victoria, Queensland in the optimum purchasing opportunity phase. WA, South Australia looking and aligning okay. Northern Territory, and as mentioned, ACT, New South Wales, a little bit confused in the slowdown phase. What that means, it doesn't mean much. In perfect honesty, state level research or opinion or media or sentiment is completely irrelevant because you cannot once again invest in that state. So even when you have very positive signs in Queensland, it's not applicable or equally applicable to the state of Queensland. You've got a lot of coastal regional mining areas that are in a very patchy and slowdown phase and very fickle at the moment. You've got inner oversupply potential issues or slowdowns, or no real movements in sales volumes, rent increases, or growth in big chunks of Brisbane. But you've also got satellite areas around Brisbane and really sort of key population growth centres around Brisbane that are absolute optimum growth buying opportunities, 8 to 10 o'clock, set for imminent growth. And as an aggregate, Queensland is still there. So you can see how you've got all of these different local government areas or regions in a state pulling things in different directions. Things become very general. So we do have this information as a live state level property clock within Ripehouse. It's not usually that useful, as I mentioned, because it's too general. But you can, we have algorithms which go in and generate property clock information for each state live to today. And we also have our own internal algorithms that, more importantly, generate property clock information per local government area. It's constantly rolling. It's live to today. So you can actually make your decisions based on live understanding of the data and the research. So I'll go into that a little bit more. But gathering an understanding of the nation into the local government areas is how we can understand and improve and open up our catchment area of interest. It's all about getting the state into the local government area right. So generally getting the story in Queensland, Victoria and Tasmania, but making sure we are potentially investing in the local government areas in these states that are driving the state forward. They're the absolute best recommendations of the macro and micro influences within that state. Let's jump in there. What I'm going to do, I am going to go into the tool very quickly. I might skip through this. I want to stress the relevance first before I go into the tools and research and live research around the relevance of live data. So the only way we can position ourselves just in front of the masses and use them to deliver us our outstanding growth is by making our decisions based on absolute, timely and relevant live data. If it's taking 3 weeks or 3 months to collate and package it up into a media report or article or filter through those silos and distributions of information, you are then relying on the masses. We have to be right on the cusp of when the buying indications align for us. So we have to be the first people almost acting on that information. When we're confident that the stars are aligning, that's our buying opportunity, and then the masses come in that deliver us the larger buying demand group to give us the growth. So that's what it's all about. We need live data. Let me know if that's sort of ringing home and making sense. I'd love it. I can break it down. I can sort of elaborate there a little bit more if need be. So, yeah, I did mention that the state of the state data on Ripehouse is live. All data across local government areas and suburbs is also live. So we're constantly monitoring on-market activity, for sale, for rent and sold, constantly updating our days on market, sales volumes, rental volume, vacancy rates, yields, all of the key metrics, occupancy type in suburbs, to make sure all of the recommendations, property clocks or health checks or whatever they may be, are live. That puts us in pole position to making sure we are making critical and clear decisions based on reality and not a previous observation of it. So timing is absolutely critical for achieving hockey stick growth, which is, I'll go into more detail soon in terms of finding the area set for imminent outstanding growth and when we can pick the end of a slow or recovery phase. Okay, I might pause things there with the slides. I have gone back and forth a little bit. I'm going to now clarify what I mean by the states of the states into the local government areas in the country. So I've just switched tabs there. Let me know if you're having issues not seeing that. You should be now seeing the Ripehouse page with the logo up in the top corner. This is the main dashboard page. Okay, so when you log into Ripehouse, you're presented with the dashboard page. You've got the 4 areas of functionality within Ripehouse. Learning, so our content and research portal is here with daily articles from experts in the industry. We've got over 20 contributors providing unique insights in the Frontier Investor. We have learning modules, so research reports, tutorials, FAQs, any outside education modules, etc., are brought into our learning centre. We have the locate silo, which is expert opinion, their strategies, and the current suburbs that they are recommending, research tools, and the design your own strategy. I'll go into more on that later. Got the acquisition, which is coming soon, around how to help you seamlessly negotiate and tie together all of the different stakeholders, real estate agents, mortgage brokers, etc., into the transaction and seamlessly move that through to settlement for you. Your portfolio, uploading your portfolio, looking at potential growth. We do automated appraisals and refinance opportunities. So, trying to work out and structure your finances in an automated fashion through your portfolio tracking. You have the Ripehouse news feed in the middle of your dashboard, which has constantly ticking through updates to content. People doing really awesome things with their strategies. So John has been able to find 191 suburbs based on his search criteria that will generate 3% above average growth. You can follow other people's rules and their strategies to try and work out. Liam's had a cracker, 166 suburbs, 9.5% above average growth. This is really the heartbeat of Ripehouse research and what we are seeing, and obviously all your account information down the side. So what we're looking at now, we've got an understanding that the state level is probably a little bit too general. Let's jump into our local government area level research. So you can see the state level research there as the top tier. The local government area is where things start to get really interesting. So you generally have enough suburbs, enough dwellings, residents to have a really good sample of what is happening, and enough sample of data to be able to make decisions based on live understanding of that. So sometimes at a suburb level, you might not have enough turnover to see or have enough sample to be able to have that heartbeat of a suburb, and at a state level, it's too general. The local government area is where your strategy and the implementation of it is made or broken. So this page is very important. There are a few different ways of finding suburbs and local government areas that might work for you. This is just specifically using the research tools within Ripehouse. What I tend to do here, across the country, let's focus, just for the purposes of illustration, I might just select Victoria as a state of interest. A lot of Ripehouse investors are currently targeting Victoria. Victoria is featured very heavily in our monthly research report, which has current 12 LGAs and roughly 20 suburbs, over 50 pages of research and our opinion around the suburbs and observations of the research. Very heavily weighted towards Victoria. I'm just filtering the LGAs for Victoria so we can compare apples for apples in the state, as an example. We know that Victoria generally, in terms of this conversation, is at the buying, in the optimum buying window for its property clock. Let's look for local government areas also between 8 and 10 o'clock on the property clock. So if you can also remember, you've got lots of different regions within the state pulling things in different directions. So what I'm doing, I'm wanting to look at those local government areas that are between 8 and 10 o'clock on the property clock, the optimum time of opportunity for enough upside towards a market peak to give us the growth that we're looking for. I also like to see on-market indications that growth is imminent and likely. So timing the market, making sure that growth is very likely to occur soon after we purchase and not 1 year after. We have been able to form relationships between lots of leading indicators of growth and been able to track and provide them to you. So some big ones, sales volumes. Are sales volumes trending upwards and at a high peak in the cycle? Are days on market steady or decreasing, and are yields trending upwards and at a high peak in the cycle? So this is all buyer behaviour. I'll go into a little bit more detail soon about the whys of that, but we're trying to get an assessment of market health in the local government area. So I do like to see at least 3 of those health ticks out of 6 before I'll start looking in most terms. What this has done now, it's very quickly got us down to a small list of local government areas. You might see the opinion score over here on the right-hand side. The higher number, the better. But that also means that the more eyeballs are on that local government area. So what we've done is we've gone away. In 2015, we had over 150 interviews over a 3-month period of experts in the industry. So buyers, agents, researchers, valuers, real estate institute members, we've normalised that information and put a opinion score, so a positive opinion score around likely growth per local government area across the country. So the higher the score, the more opinion. Now we've constantly updated that with media observations about that local government area and even suburbs. So the higher the score, generally the more eyeballs, the wider the lower sophistication of the audience who is now starting to look at this local government area or suburb. So you can see a lot of these are already on the radar. Some of these might be up and coming and haven't really developed an opinion score. Some of them have quite a high opinion score. Anything over 100 is actually quite high. So Ballarat's been talked about by those supposedly in the know for quite a while, and it's over about 12 months in Ballarat as an example. My point here is you've been able to very quickly get down to the absolute pinnacle of local government areas driving through Victoria for growth. And one observation, which I have sort of been mentioning in the last couple of months, is you've got a very strong bias towards lower purchase prices, especially in Melbourne markets where the median is usually a lot higher. Yeah, the highest LGA in terms of average price is 738,000. The majority of them are under 400K or around that 400 to 500. So mid to lower socio and price point local government areas are in alignment. So you've got this mid to lower chunk of the market that is still in the optimum buying window, whilst the upper end of the market, upper to media end of the market, and a lot of inner mid-ring Melbourne is already in the slowdown phase. So you've got mixed markets heading in different directions at any one time. This is one generalisation that I've noticed, and it's been quite a strong trend in recent months around that price point and below. What we are trying to do here is now, I'll just jump in. So we've got a short list of local government areas. I'm just going to jump in and talk about how we then zoom in and find the individual suburbs. So the interplay, as mentioned before, the importance is the interplay between the different stages. So we get the local government area right to deliver us the imminent growth. How can we reliably find the absolute pinnacle of suburbs in that local government area to deliver us the growth? So you're always going to have suburbs that are falling behind, that are not really doing much, and others that are really dragging the local government area forward. We've got to get that conversation and outcomes in alignment at each layer. That's what it's all about. It's just about trying to break down why people might be moving towards the local government area and how we can use those changes and shifts in people moving towards the area to deliver us the growth. Okay. Just probably a bit of a pause there. I've recently done in Sydney and Melbourne a full-day advanced due diligence event where I did go into, in a big chunk of that day, a lot about buyer behaviour, and we really did drill down into the process and the repeatable process of how momentum starts to build in a local government area, and what are the first signs that we see in changes to the metrics and the research, and when is the absolute optimum buying opportunity in that local government area. What it really does break down to, I'm going to jump back in now. We're going to look at a local government area and analyse it. For the purposes of this illustration, I've gone in and found I'll forgive the pronunciation. Maribyrnong has 3 out of 6 ticks, 10 o'clock on the property clock, reasonable opinion, but not too strong. Got strong price trend growth already, good and reasonable yields, healthy days on market, 84. It's in Melbourne, okay? Got lots of dwellings, nice sample size. Let's use Maribyrnong. So the local government area is stacking up well. Not much is happening in the suburbs themselves. So generally, they might be cancelling each other out. Even the suburbs themselves might be going in different directions at different times. So as an aggregate, the local government area then becomes too general. So when we've come down, I've clicked on the local government area. It's brought me into this screen, which is our Explore the Nation screen. What we're trying to do is visually represent each suburb in a way that you can understand it. So the metric score is the stronger the current indications of on-market activity are for imminent growth. So we're looking at sales volumes, yields increasing and at a high point in the cycle, days on marketing decreasing and very healthy. The stronger the on-market signals, the stronger the metric growth or score there. So we're looking for nice, strong metric stories. We're looking for The investor interest score is how many other Ripe House users are actively researching this suburb and looking to invest there. So the stronger that score, the more the word is already out. The more advanced investors using Ripe House are actually targeting this suburb. And once again, we also have the opinion score for suburbs. So the higher the opinion score, the word is out. You've got lots of eyeballs. The media is onto it, etc. Income, stronger, that means high yields, but also nice stable vacancy and rental volumes, and investability. So we want to be investing in the absolute optimum streets, which I'll go into in a moment, and the perfect properties to deliver that growth. So the optimum properties, how many are currently on the market, and how many properties are potentially going to deliver us our outcome. So we have to be able to invest in that suburb, in those key streets. This is telling us that these suburbs have more properties for sale in those key streets, which I'll go into in a bit more detail. So what we've done, we've come into a local government area that, at the local government area level, it all looks rosy. We can't really find any growth stories there at a suburb level, okay? So I just wanted to really cover off how that might change and how we might then get that cohesion between the two layers working together. What we need to do is we need to find suburbs primed for immediate growth. So not in 6 months, not having moved or already started to move for 6 months and attracted a lot of other eyeballs. We need to beat the masses and then use them to deliver us our imminent growth. And we need to be able to look for leading indicators, stars aligning to demonstrate hockey stick growth. So this is what hockey stick growth looks like. We've had, these are just very varied charts. It's a very common pattern of a market or a business or a world carbon emissions. You've got a lot of things pointing in different directions, and the stars align, you get an amplification of results, and things start moving in the same direction for the similar reasons. So we want to position ourselves after the 5 or 10 years or whatever has been happening in that market, that local government area, that suburb, to the stars aligning, then suddenly things really start to move. We want to have very strong indications that it is about to move and position ourselves just before the imminent growth. I'm going to be talking through in a moment how we find that growth and those imminent growth signals or buying signals for a suburb, but they do equally applicable to a local government area, which I'll sort of relate to both. But how, I guess I'm just trying to quantify and just get making sure you're all on the same page and understanding. Does hockey stick growth, do you understand the benefits of being able to position ourselves there, the opportunity cost of money, and being able to assign our resources to have an immediate return as opposed to waiting for it? Just hands up, yes or no. Potentially, just so I understand that we are sort of seeing things. On this graph here, you can see things are quite flat in the 80s, the 90s, into 95. Things starting to align in 96, 97, and then they really start shooting off in about 1998. And then at about 2000, you're at the high point in the cycle, and there does seem to be a little bit of a correction after that. Where do you think you'd like to purchase there? Just give me a number. 1980, 1995, 1998, 2000. When do you think would be the optimum opportunity to give you return on your investment with the highest or the least opportunity cost or upside in other methods? Okay, Tom says 92. Robert says 98. So there's a bit of a delay in the, so San 2000. So what we're, just to probably re-clarify, we're trying to buy when things are about to move. Not once they've moved, we're trying to position ourselves just before the growth. So Tony 1999, Jaro 2000, Yao 99, Lisa 98. So what we're also talking about is there's no crystal ball. We want to give us our absolute optimum rate of return as quickly as possible. So 2000 things have already moved. 1995, we've got too long a delay. Holding costs are quite high. We haven't really had the growth to justify it. 98, 99, things are really starting to move, and we are getting the biggest bang for our buck in the shortest time period. We can then choose to sell down assets or borrow against them and move into other investments. But it's all about positioning ourselves there, 1998, 1999 for imminent growth. So that's just clarifying where we want to position ourselves on that hockey stick. The results, if we can do this, this is an actual example. So this is Guy Williams, who's a Ripe House user. been using the software for about 14, 15 months now from memory. In his first 10 months of using the software, he's actually purchased 10 properties. Okay, the average annualized capital growth for each one of those 10 properties is 25% growth in that first per annum period. His cash on cash returns were 105%, assuming a 20% deposit, and his average yield for each property was 6.25%. So what this is all about, you're positioning yourself for imminent growth, but one of the key buying behaviour factors for imminent growth is that you've had lots of rental growth in the local government area and the suburb. So you've got lots of people moving towards the area, which I'll go into in a moment, but they are drawing up rents first. So if someone's moving to a local government area they haven't been and lived in before, they will generally rent. So that's creating a lot of demand for rent and pushing up rent per week numbers. That hasn't translated into growth yet. So you start seeing rents and yields really sucking up to a really high point in the cycle for that suburb. So when you see that and you start seeing those people who have come into a 6-month tenancy really loving what they're doing, they're doing great things at their new job, they want to now come back and buy. So you start seeing sales volumes increasing. And that's about a 6-month delay. It might be shorter, it might be a little bit longer. But rents, yields increasing, then sales volumes increasing. If developers have already caught on and they've put more stock into the market and subdivisions or whatever it may be, you then, if they haven't done that, you will then see days on market start to decrease as the demand is outstripping supply. If you have already seen lots of developers come into the market, sales volumes are increasing, but days on market may be even increasing at the same time. So what we like to see, these are the leading indicators: rents increasing, yield increasing, sales volumes increasing, days on market steady or decreasing. That is when the stars align for imminent hockey stick type growth. So this is the system. Basically, Guy is able to use the software, which I can show is using it in much the same way I'm demonstrating now, to purchase 10 properties in 10 months, average capital growth in the first year of 25%. So this is all not, we're not trying to obstruct the individual details, etc. If you'd like more details about Guy's story, we've got 4 case study articles on the frontierinvestor.com.au, which is part of Ripehouse. They go back and forth. You can see the individual properties that Guy was able to purchase, where he purchased them for, how much, what rent, and what growth he's had on them. It's all detailed there for you to be able to rinse and repeat it. It's using this same hockey stick type system that we're trying to talk through tonight. Okay. Let's jump in, because we've got the local government areas right here, but we haven't got the story right at the suburb level. So we make it a little bit easier for you. Over here on the left-hand side of the screen, you've got the big green. So what that means, it means the local government area is good. It means that the suburb has very strong metrics. It has strong interest from other sophisticated investors within Ripehouse. It has reasonably strong and positive sentiment from the media. It has good, strong investability in income. It's big and green. So the one danger here is that it may already have too many eyeballs on it. So you've got very high opinion, lots and lots of opinion, and high opinion scores means that the word is out in the media. Sometimes you might like to align yourself with a boomerang, which means it's the same as a big green, but the opinion score is low. So you've got the interest, you've got the metrics, the income and the investability, but the metrics, the opinion is low. It's a boomerang. It hasn't emerged yet. What you're trying to do is align yourself with an outcome and a shape. So I generally find a boomerang and undercover deliver the outcomes that we're trying to position ourselves for hockey stick growth without the masses yet on the case. We've got a lot of familiar faces: Moreton Bay, Gold Coast. A lot of Ripehouse users have been investing there since Christmas time for great success. You also start seeing a lot of market heat and investor interest from the masses in these markets. So you might have 3 or 4 offers on the same property, potentially for investors, and now you're competing against a lot of others in the transaction. What I'm going to be focusing on tonight is I have seen in September the emergence of a lot of individual markets. So in what I mean by that, I'm going to use Newcastle as an example. You've got Wallsend, which has emerged very strongly in August into September as a suburb with outstanding growth, alignment and fundamentals. It's really looking strong. But the story for Newcastle overall is an area, region and LGA is conflicted, and it's not really in the optimum opportunity. So we have seen the emergence of a lot of individual suburbs into September that stand alone, and they do offer good opportunity as a suburb, but the story up into the local government area is not really that cohesive. But I will use Wallsend as an example tonight of the representation of a lot of these individual standalone growth stories. Okay, just I'll leave that there because we've found a suburb now. We've used the big greens. The metrics are all in alignment. The LGA is reasonable. We've come down now into the suburb, into our unique map-based analysis page. Now, I'm just going to frame things up a little bit before we go into here because now we've got to make sure the suburb is right. I've just basically covered off on this, but I wanted to just reiterate. So when a local government area and a suburb starts aligning, you may have at the local government area level new train lines, new shopping schools, transport, unis, hospitals, Westfields, IKEA, whatever it may be. It's increasing the demand and the utility in that suburb. So population might start being moving towards there, the utility and value to individual current residences increases, public building works or whatever, it all results in increased demand. But that doesn't necessarily mean growth yet. We need to start seeing, is it when the train line is announced, when it's finished, when people start using it, or maybe a year afterwards that growth starts to occur? So all we're really talking about at the local government area and at a suburb level is that demand increases for people to dwell and live there. Then generally we see them renting first. So as I mentioned, rents increase, then yields increase at the same time because growth hasn't occurred. If rents increase but yields didn't increase, then we've already had growth occurring, okay? So we like to see these two things happening first, then sales volumes trending upwards as people start to transact into the market. So you've got that first groundswell of people renting, now buying, and then you've got the really early investors coming in and targeting those high yields and adding to the buying pool. So sales volumes are up. You've got days on market steady as a bit of check and balance. That's when growth is likely to be imminent and occur. Okay, so this is what it's all about. The growth is delivered, by the way, by the masses. So now lots of other owner-occupiers moving to the area, very low and under-sophisticated investors as a group coming in and buying indiscriminately. And they are the ones that the bigger the buying group, the bigger the demand, the bigger the likely returns for people who get in before it is what we're trying to do. So how have we found these within Ripehouse? We have talked, and we've only talked in terms of the research tools in the middle, but you can also formulate your own strategies. And we've had over 400 different investor strategies from Ripehouse users coded and developed within the platform, and you can actually go in and you can see how other investors are structuring their search, and you can use that as your own baseline. Or we also have, so my understandings and current suburbs recommended for pure growth. You're able to look at my profile as an expert within the platform, see the current suburbs and see if it might be a relevant strategy to you. We also have Jane Sachs-Smith, who's a renovation expert, providing her expert status and stage strategy page on that you can literally click on Jane and find her current suburbs that she is recommending using our Design Your Strategy tool. And also Dave Ward, who's Capital Growth Plus development. Very strong on the capital growth side, but with development upside as a strategy you can take off the shelf. Watch that space. We are rolling that out with lots of other experts coming in and providing their unique insight and approach. So depending on which direction you'd like to go in, you can own the research tools in the middle. This is what I'm demonstrating now. You can go and design your own if you feel confident in doing that, and it will spit out your list of recommended suburbs, absolutely optimized to exactly what you want to target. We've got over 100 metrics that you can use at the local government area and the suburb level to find those unique suburbs that are doing what you want them to do, or you can just delegate to the experts. We've got research reports per month, which are giving the best bits of the absolute pinnacle of research and the derivative of the suburbs and property recommendations. You can, either way, whatever you're comfortable with, we try and make sure it's easily accessible to you. Okay, so we've come across Wallsend, a little bit of background. Really good growth story at the suburb level. LGA not so strong, okay? So in terms of the whole country, we can be really fussy. I would prefer to see really strong growth stories, as discussed in our September research report in the core. It's vetted, it's gone through a lot of layers of us as internal, myself and my staff at Ripe House, vetting the research and putting that human touch on it. The story in Newcastle is a little bit iffy, where you have Wallsend as a very strong growth story, but Newcastle itself is a little bit conflicting. That's just a note here. Didn't quite make the report, very close as a bit of a tip, but let's analyse the exact streets to target within the suburb. Just to clarify, if we get the street right, this is when we can really turn the screws on growth and delivering ourselves absolute optimum and outstanding growth outcomes. Okay, so if you're just thinking about Wallsend, you've got people moving towards that area for job growth or whatever it may be. They are going to be moving towards the area to do the similar types of things. So they might be all families targeting new, industrial or tradie type jobs. Mum and dad and 2 kids. They all want 4-bedroom houses with 2 baths, 2 cars. They are moving to the suburb for the similar reasons. So they are demanding a certain property type in a certain street area. They want to be near the shops and schools. They don't want to be over near the cemetery or over towards where the owner occupiers live with big pools and cars and streets or whatever it may be. They generally move towards a suburb for the same reason, into the same types of properties, into the same streets. So that is where the demand is going to be strongest. That is where the rents and yields are going to grow first. And that is where the growth is likely to occur first and be amplified. We want to position ourselves there. We want to think about the suburbs that you live in, which streets to seek out and which ones to potentially avoid. It's critical in delivering and amplifying our results. How critical? So we've gone through and back-checked using our research and data, which is fully owned by us. We own all of our own data sets. We have for sale for rent and sold listings going back to 2011. A lot of other data going back 15, 20 years. But we also have some really interesting data sets. So the exact concentrations of public housing, plus or minus about 2% for every street across the country. Distributions of owner-occupiers versus renters in those streets, houses versus units, incomes, rents, yields, all tracked at a per street level. So we've looked at all of these things, proximity to shops, schools, transport. We've looked at all of these things and tried to work out the relationships between certain elements, certain groupings of elements, and above average growth. And we've been able to find 5 elements that form the Ripe House sweet spot in each suburb that together generate 21.9% above average relative returns to that suburb. So if the suburb went up 4%, you would expect almost 5% in that street area if you get the street level right. In Sydney terms, for all those 52% of people tuning in from Sydney, 21.9% more growth means $240,000 extra capital growth in the average Sydney property going forward from now for the next 10 years. So $250K extra if you get that street level right. What do you need to look for? So 5 things. Low public housing. So the lower the public housing, the stronger the correlation between 2 above average capital growth. There's a lot of common sense and buyer behaviour ideas there around public housing being more stable and people not being as transient and higher quality tenants, etc., with lower vacancies, providing that bedrock for growth. But under 15% for the average suburb across Australia, you want to find lots of the in-demand property in that street. So if people are coming towards a suburb for 4-better houses, you want to have that street the focal point of 4-better houses and not home to 1-bedroom units. You want to have strong tenant demand. So this is all coming back to the local government area and the suburb. We want to be in the streets that people are demanding. So they've already driven rents up. You've got above average rents, above average yields, and strong tenant demand, the big 3. So these 5 things together, this is what constitutes the Ripe House sweet spot. It's generally only 10 to 15% of each suburb. Some suburbs don't have a sweet spot, but it's absolutely critical to check and get it right, okay? Let's show you how to find them. We've got Wallsend. We can see exactly where public housing is in the suburb. 6% overall. This strong red area, the darker the red, the higher the public housing, has 32.7% public housing. That's a very strong no-go zone. You'd have a very strong indication of public housing in those streets, and it might really hamstring your growth. Occupancy type, strong yellow is renters, green is owner-occupiers. Obviously, a lot of renters in the public housing area, a lot of owner-occupiers down here in the south of Wallsend. Property type, houses versus units, rent per week, income, yield, and where the key amenities are located. So interestingly enough, the strongest yields in the suburb were in the owner-occupier streets, but you might not have much rental turnover. You may have longer vacancy rates because there's fewer or less demand for tenants or people wanting to live there as a tenant. But when you do have a tenant, you might be able to achieve higher than average yield. So there's a bit of a conflicting story there, okay, if that makes sense. There's a huge amount of information on this page. You can really get to, down to the details of what's happening in the suburb and become a local understanding. Over on the right-hand side, you can do a lot of really cool stuff around what is happening with the suburb level. So you can compare this suburb visually with the suburbs around it based on yield. The darker the red, the higher the yield. So this is a very high yielding suburb compared to its neighbours. All of the key metrics you can once again look at the suburb level. So an amazing resource, this page. You can see all recent sold properties. You can view what they actually sold for. You can see all current rental properties on the market. You can do neighbourhood comparisons, ripple effect comparisons. You can view a suburb report with a huge amount of detail. Each red icon on the map is a current for sale property. We track, like Google as a search engine, the full listing history. So you can see this property has been on the market for 91 days, 2% discounting. So you can see when the vendor and the agent have discounted the property. There's a huge amount of information there. All you need to simply do, show me where the sweet spots are. Click on the toggle at the top left-hand side of the screen. Click on the capital gains toggle there. It'll pre-select and arrange the different 5 metrics for you. You can override that. You can target streets that are optimized towards renovate for profit and flip, if that's what you'd like to do. You can click on optimize for cash flow, but this is a capital growth strategy. It's going to output 4 areas. These are the absolute pinnacle of this suburb. These are the 4 street areas. Now I only want to see the in-demand property type on market in these streets. So we've got 3 and 4 bedroom houses currently most in demand. That's available through the suburb report tab, but it's also shown to you via a text pop-up when the suburb loads, which if you didn't notice that. It's now displayed to us 2 properties on the market that currently tick all the bills. One of them has been on the market for quite a while. So you might actually see within Ripehouse the days on market data is a little bit higher than the average. That is because if a property is listed for sale, didn't go so well, they took it off the market and then relisted it 6 months later, we classify that as the 1 sales period because they haven't transacted, they haven't sold the property, they've just retacked. So that's information that you need to use as your advantage. So our days on market data doesn't start and stop. It is cohesive all the way through. So let's just use this one here, a 3-bedder, 91 days on market, 12 Kemp Street in Wallsend. It's in demand. It's in the sweet spot streets. We can see all of the images. It looks to be in good condition. We're trying to understand the condition of the property to do a appraisal. So I'm just going to pause that there. I want to talk a little bit more about the property in a moment. If you've got any questions, let me know. If anything of that needs to be cleared up, let me know. Sorry if you've got blurry screens. A couple of you have come through with issues around blurriness. If that is occurring, please reconnect using the bottom at the bottom. Otherwise, you are able to view this directly in Google Hangouts. I did share at the beginning of the telecast Guy, shout out to Guy, is here and listening. How are you, Guy? If you are having problems, you can jump over onto YouTube and watch this directly. I'll just share that link again for you all. It may improve your pixelation issues. Okay. Let's jump right in again. So I just want to talk about how we can actually really supercharge our results. Guy is an expert negotiator, so shout out to Guy. We did do a webcast about 6 or 8 weeks ago with Guy was kind enough to come in and help us understand how he negotiates, and look out for some really amazing negotiation content that Guy is helping us and really charging forward with very soon. He's an amazing and expert negotiator, an absolute wealth of knowledge. But what we're trying to do now is understand the property, its condition, and the context of its sale to be able to negotiate and potentially negotiate at value or under value. We need to reliably assess market condition, find a valid comparable, and not rely on an automated appraisal. So we haven't bothered building out the automated appraisal engine within Ripehouse. We do, and it is quite strong and resilient. We still encourage you to own the process of formulating your comparables and getting an exact understanding of the value of the property. No automated appraisal is ever going to be able to deliver that to you. If you've got an appraisal range, there's inherent inaccuracy. There is one optimum valuation for that property, and the way to best get it is by doing it yourself. And we are also here to help, but we then start using those comparables because it's a critical part of the appraisal process to negotiate on the property, which I'll talk through in a moment. This is all to try and appraise and buy under market. So how we can do that within Ripehouse, you first gauge the condition of the property. This is unrenovated, but quite tidy and well presented for sale. So I would, I'm doing a balancing act. I'm trying to consider the property is in average or poor, average or good condition, and putting it into one of three buckets. And then our software then will go away and be more likely to find other comparables in the same bucket. But it does seem to be in average condition, pluses and minuses here. I'll override our automatic assessment of the property. We have internal algorithms that will try and assess the condition. In this case, I got it wrong. When we override it, it's actually going to learn from that and get better next time. We can see the full listing history. So listed on the 8th of June for $585, discounted, and now discounted again down to $520. Visible or quite demonstrated signs of distress. We can see the suburb and area level information. This is going to go away and find our top 5 comparables. It's going to present them in order from the most likely comparable first. I like to get 5 comparables that have a very tight range. So this one here at 323,000, is it inferior? It's a lot less than all of the other 4. It does look to be a smaller and inferior property. Now we've got another comparable at 455, which is inside the range. This one here at 375 may now be the weakest link. We're trying to make sure we've got 5 comparables that are as tight a range as possible and in a similar condition. Okay, if we own that process, we're going to be really confident with the appraisal for the property, and we can actually use those comparables to question and negotiate effectively on the property. We're going to go away. The software is going to average those 5 comparables. It's going to tell you if there's positive or negative adjustments based on the location of this property, concentrations of public housing, shopping, schools, and transport. We know how those things affect appraised values. We've done a lot of back checking and found correlations between distance and those factors. They are the big factors that adjust values, and it gives you a final appraisal price. You can ask us at Ripehouse for a second opinion, and you can print it out in the report. So it's giving you a lot of understanding and resilience with the property. Please ask any questions there. I've skipped through that. I just probably wanted to leave it there and ask a question. Are you looking for amazing growth? And can you see how this fits together in a system and a repeatable process? I guess you want to really grab the bull by its horns and kick your investing and portfolio towards these type of results and really drive the outcomes towards, I suppose why we're all doing this, and it's lifestyle, it's increasing our net worth with an ultimate eye to retiring and having a retirement that we're really dreaming about and striving towards. That's what it's all about. It's about being able to get there more reliably, I suppose, with more systematic and science that's allowing us to make clear and concise decisions. It's all about getting towards our retirement dreams. Before I jump into the second module, which I'll jump into how we find areas to potentially avoid, and just a really quick crash course in that. I am aware of time. I just wanted to thank you before we jump into that for attending. It's really obvious that you're excited about sticking around and learning about property and taking the time out. I love talking and sharing what we see here as a DIY investor with other investors. I'm really excited about charging towards growth and delivering amazing results together. So yeah, a really big thank you. Before I go on, I'd love to make an extension of that thank you and offer. Ripehouse is a subscription service that is only available outside via an annual subscription model. We open and we optimize and we spend a lot of time and resources on delivering you research and outcomes and our tools and platform over a year period where we stand by your side and work with you to drive and deliver those outcomes. Only available through an annual subscription. Everyone else out there, come to the site, or you'll see it's $1,597 per year. I'd love to offer a big special thank you for joining us tonight of a $400 per year saving, bringing that down to $1,197, only available because you're on this webcast. There's a big thank you. And I'm only opening it up until midnight tonight, just to make sure we all come together and we all start working, and I can help you. The software is there to work together towards your goals in the one mass group and movement. There's a lot of power in doing that together, and that's why we're putting the midnight stop on this offer. If you'd like to jump in right now, type in www.ripehouse.com.au/bonus. I have activated that bonus on that page for you. You click on the green Get Started button on that page, type in your basic details, name, email, and phone. It's pre-filled a big thank you coupon for you to bring that price down to $11.97. Enter in your basic details, credit card details. It's securely processed by Stripe, not via Ripehouse. It's between you and Stripe. That comes in and creates your account. Within a few minutes, you'll receive your welcome email, login details, information about how to start digesting our research, our most recent research report, tutorials, and how to start getting involved in the Ripehouse community with advanced and private webcasts and content. It's all there. To get started, www.ripehouse.com.au/bonus. Look, the second part of this evening is areas to avoid. And I wanted to really break down what I've seen in the last year or so about how things deteriorate really quickly. And it can happen in a few different ways. So what I might just do firstly is describe the three different ways. So the first way I would define as reverse utility. So if you can remember back to why an LGA or a city or whatever it may be the stars starting to align, that may be you have a new mining opened, employment provider, transport hub, or whatever is created, a train line to the city is created. That is now increasing and attracting people towards the area. Rents, yields, sales volumes all increase, and days on market potentially decreasing. They are our signs. So if you have that utility provider, the demand is just stripped out, so employment closes down, tourism goes bust, or whatever it may be, it has a reversal. The sales volumes start decreasing very sharply. Vacancy rates start increasing. People can't rent their properties out because you don't have the people renting anymore. Rents start decreasing. Growth or property prices haven't necessarily started to drop yet because people haven't got a desperate and have to sell. But as soon as rents start decreasing, that's putting stress on serviceability, etc. Yields are decreasing because prices haven't changed, and then prices might decrease because people are then being forced to sell because they cannot service their loans. So it's in the same ways, a flip around in a reverse order of a lot of the same things that you see. So I guess the basic question is you're trying to look at a property as a buy, hold, or a sell, and are you seeing the reverse order? Are you starting to see sales volumes really dropping? Are they at a low point in the cycle for that suburb, and then accompanied by increasing vacancy rates and lowering or stagnant rents? That's some potential signs that an area is having reverse utility or undergoing reverse utility. Another scenario is when you start having the masses. So the big groups of all the lower sophisticated investors coming in, the mum and dads or whatever they may be, and buying indiscriminately and stripping out and corrupting the demand or all of our advanced metrics that we're really looking at. And this happened in Logan last year, August, September in Logan. You've got a lot of public housing in Logan, a lot of no-go suburbs, a lot of no-go streets, 70-80% public housing. So Ripehouse users were using the software. They were targeting very distinct pockets of certain suburbs, half a dozen suburbs across Logan. Just say it might have been 2,500 dwellings across the whole local government area for absolute optimum buying opportunity. Then you have very unsophisticated, larger buying groups coming through and the masses and stripping out all stock in the market indiscriminately, whether they had illegal builds underneath, illegal build heights, problems with the property. They weren't in demand. They might have been a 2-bedroom house or a three-bedroom unit or whatever they may have been, or they may have been entire public housing streets. That has just stripped out a lot of the stock in the market, and then they have been naturally gravitated towards the good properties. So you've missed the boat, okay? It then becomes an area to avoid because the good stock has now been lumped in with the bad stock and people are paying the same amounts for them. Okay, so you've lost your value proposition. The third area is potentially when you start seeing a lot of overlap in the offers made. So Ripehouse is all about positioning you just in front of the masses, but as soon as you start seeing 3 or multiple offers on the same properties in those Ripehouse sweet spot streets or other streets, you're starting to see indications of that momentum growing, and that might be your first signs that an area is starting to be avoided. We've sort of, Moreton Bay has been in and out of the cusp of that for the last 3 or 6 months, or 3 or 4 months, where it's cycled in. You've got a lot of eyeballs on Moreton Bay now, a lot of investors, and now you're starting to see lower sophisticated investors come into that market. And individual properties, even Ripehouse users coming through to me and sending me an email saying, I've just made an offer on a property. We've had 5 other offers over that same weekend on the property. It's one of those signs that it's starting to be avoided. Yeah, I'm just trying to break down the scenarios. I probably just wanted to reiterate, Ripehouse is a community of DIY investors. So we really try and share and help each other. I'm a DIY investor. It's all about empowering us to make decisions. Technology should be here to empower us and make clear and concise decisions. It's all of our research and software, etc., is all designed to be able to help you to make these decisions. We have the modules, research reports, monthly capital, got the renovate for profit report, and now we're rolling out other reports to suit your strategy. Research tools, as I've demonstrated, we've got the strategies built in and to design your own strategy. So to different people and how they might go about their search, and it's all with the DIY investor in mind. Okay, we have also, as a member, as an annual subscriber, private invites to unique and advanced webcast events, group coaching, and live phone, chat, and email support, all available to you. Technology is designed to help and not hinder, and this is what it's all about. This is why Ripehouse is here. We're really trying to stay close to what you're doing in property, how you're doing it, and optimize and empower you to do it. Okay, this is a little bit about what other people in the industry have been saying about Ripehouse. A lot of familiar names, a lot of people that we've worked with for a very long time. Guy Williams is on the line. Big shout out to Guy, who, yeah, I love conversations. He's been one of our you know, he's had some really good results with Ripehouse. He uses the software really well. He's also very experienced and a very competent investor. We have a lot of investors buying their first property through Ripehouse, gaining the confidence to actually do and make that first step because they can see the researchers live and it's quantifying what they're seeing and thinking. And it's also, in a lot of cases, helping to remove emotion because you've got an outcome that's defined to you as an investor and someone who's really trying to make that first investment. We have a lot of people investing in property using Ripehouse who haven't actually or don't own their principal place of residence because it allows them to look at the whole country as one and invest in areas that they wouldn't necessarily want to live in, but develop and offer the best opportunity to them so they can step up into buying where they want to live. And we have a lot of professionals in the industry using Ripehouse for its research and advanced applications. So just once again, before I jump into the Q&A, a big thank you. $400 saving, $1,197 is only available to you for watching and being with us tonight. Also, we are currently release a capital growth report per month, and James Slack-Smith and I also co-author a Renovate for Profit report, the top 5 current Renovate for Profit suburbs. It all is then backed up by the research, and you can then jump in and find individual properties, etc. They're usually $97 each. A big hint, we are actually rolling out another raft of 3 more reports per month for different strategies. They are all included for free as a big thank you as part of this offer. You don't have to buy them purchasely. They're all included as a thank you with this annual subscription. So you can really use those as a guide to then implement and roll out the strategy. So we also, as mentioned, have private group coaching and webcast events. So annual subscribers are the only ones that are actually invited to those when they do occur. Every 6 or 8 weeks. That's over $1,800 of value just based on what you see in front of you. I'm really trying to basically, make what you're seeing so approachable and something that you can really sink your teeth into and empower yourself to do it. So this is why I'm trying to package it in a way that it empowers you to move forward and make great decisions for the 12-month period. It's all about you have to be able to use all of the resources packaged together to be able to make clear and concise decisions. Just to reiterate how to lock this in, go to www.wipehouse.com.au/bonus, the big green Get Started button there. Just enter in your basic details and payment details, which is provided by Stripe to get started. Otherwise, if you don't want to stick around for the Q&As now, I'm aware of the time and I do apologise for going over 9 o'clock a little bit. A big thank you for coming along. I hope you've got something out of the content, even if it's just changed the way you approach investing. If it's changed the way you've recognised data and research or how things all fit together, I hope you've got something out of it. I'd love to hear your feedback, positive or negative, whatever you've got to say. Please let me know on the chat bar now. If you don't want to stick around for Q&A, I'm pressing the mute button for a few minutes. I'll gather the questions and come back. A big thank you. I'll see you guys on the other side. Thank you. Okay, I might just jump straight in there because I've got the questions coming through, but I can get started on them also. Yeah, I might go through. So first, Kim is asking, how do I find the experts? I'll jump into that right now and show you that whole section of the site, if that makes sense. So we use the dashboard as our first port of call. That's what you're automatically taken to when you log in. It's in the locate phase. So as mentioned, you've got those 3 ways of finding. What you're trying to do first is find suburbs of interest that are ticking the boxes at the local government area level and the suburb level, okay? Once you've found those suburbs, you save them to your My Suburbs list. They then appear down here in your Suburbs list on the right-hand side. You then jump into the map page for each of those and search for properties on the market and go away and negotiate. So 2 stages: search for suburbs, get your shortlist sorted out. You might only do that every 4 or 6 weeks. Then you go in and start finding properties every day, jumping back in. 3 ways of doing that. You've got the research tools, the design your own strategy tools, or the experts. So you jump into it through the locate, click on experts. Currently, we've got 3 experts programmed in, myself, Jane Smith and Dave Ward as a researcher and buyer's agent. What you can do with Jane's example, click on her more info. It goes away, it quantifies her strategy in terms of she's very strong on growth, not so on cash flow, reasonable on scarcity, which means is it inner city, Bondi Beach, or inner west, eastern suburbs, northern beaches. You're close to the CBD, you've got natural drivers of longer term growth. You might have an average of 1% above average growth every year for 25 years, but you might not ever have that spike. Okay, that's what a scarcity strategy involves. Renovate for profit is obviously Jane's wheelhouse, and not so under average on the development. She doesn't really focus on the block splits or subdivisions, etc. for high density development. A little bit of understanding about how you'd expect the growth to occur with Jane, and that is actually quantified, back checked. Currently, I'll skip down the bottom. She has more than 72 sales per year, price disparity between the lower and upper quartile of 40%, over 30% tenants, under 3% vacancy, 2% ripple effect for the suburb, within 20 k's of CBD is Jane's strategy. This has gone through and back-checked every suburb in the country for every month, going back up to 15 years, and found individual buy points where a suburb has satisfied those 7 strategy points. When you buy in each of those buy points, you'd expect quarterly growth of 1.9% above average, and in the next year after that, 8.4% above average. So very strong on the capital growth side, Jane. She's sort of hit the nail on the head there. Currently, she has 25 suburbs that suit her strategy. That number in those suburbs is only available to Ripehouse annual subscribers. Okay, so that is not available to the public. You can gauge and you can see the exact numbers and the locations of her suburbs, and these are actual real-life properties on the market in the Ripehouse sweet spot streets in those 25 suburbs. So you can get a gauge of the properties themselves. You can quantify LVRs, renovation costs, total costs needed to implement the strategy, and the pros and cons of it. So we've tried to quantify the different strategies and experts, and you can align yourself more with one. So I hope that's answered your question there. I went into a little bit more detail. Okay, so portfolio tracking is you upload the details, so Jaro, upload the details of your properties, your individual properties in your portfolio. You set, if it's principal place or investment, it will then constantly and update appraisals for that property. Also, it will let you know estimated market rent for the properties, so then you can gauge if you can moderate and increase your rents, or if you also have likely equity in those properties to then refinance. So it helps you structure which properties you might refinance first, and it also allows you to access our outstanding or mortgage rates in market. So it sort of shows you how you might be able to save on your mortgage rates and quantifies that for you in the portfolio tracking. So it's really just helping you understand your net position with the properties and then ordering when to move next. Okay. Okay, so just to clarify, this offer is only available for this evening for people attending the webcast. It's a big thank you to bring you in together, yeah, it's only as a thank you for coming in. So also someone has asked around where the data is from. As mentioned, we own all of our own data sets. Some of those data sets are based on ABS 2011. We've just done a census. We are updating our data from the census 2016, obviously when it's available. But having said that, we have constantly been updating and improving those data sets based on our observations. So when public housing information has changed, we have then gone in and manually changed that. So we're constantly updating that at a local government area level. Other data sets like property, sales volumes, days on market, etc., we own and internalise all of that data, and that's when we generate some of our, our property clock algorithms, etc., constantly rolling and spitting out those recommendations. I've got a lot of questions here that are quite subjective to individual requirements or what you're trying to do. I might jump to them individually. Zach, I'm happy to talk and have a chat about those areas. Kalanga, looking quite strong. Areas to be avoided in that suburb. Sweet spot streets with very nice properties in them in Kalanga. It's actually one of the suburbs that is included in Dave's strategy and his suburb output. Tony, public housing does not include defence housing. It's a completely separate proposition. Yeah, Oliver's mentioned if everyone's doing this, then won't we lose our edge? I guess it's all about staying ahead of the curve. We've got over 1,000 people using Ripehouse. How many? There's 2 million investors in the country. I guess if it started to get up towards 10%, 1% or whatever it may be, that's when, yes, I guess generally things are constantly moving forward. We've got Ripehouse is all about consistently improving the outcomes, so we can consistently, as a group of DIY investors, position ourselves at the absolute pinnacle and the immediacy of the optimum opportunity. So I'll stick on the line. A few questions to get to that are quite subjective. I'm happy to stay here and answer those, and any other questions, I'm in the chat bar, come through on the live chat on the site. I hope once again you've found the content in this evening interesting and insightful. Please, I'd love to hear any feedback that you do have. Once again, talk soon.